All right, hello. Let's fire up another edition of Taxes and Retirement Live. This week we will be talking about charitable giving, but specifically how to do it in the most tax effective, tax efficient way possible. So it's a win-win. Not only does the charity get something, but you also can potentially maximize or minimize, maximize your deduction, minimize your taxes for giving to charity in certain ways. So hold that thought. Let's go over the dad jokes for the week. Again, I like to think I found some winners. First joke. I found out my girlfriend is really a ghost. I had my suspicions the moment she walked through the door. Like through the door. Yep. Next. Ladies, if you can't appreciate your fruit jokes, you need to let that man go. Mango. Mangoes are seriously my favorite fruit. Not easy to find good mangoes. It's real easy to mess up a mango, either not ripe enough or cut all wrong. But anyway, big fan of mangoes. Final joke for the night. I went to the beekeeper to get 12 bees. He counted and gave me 13. I said, "Sir, you gave me an extra bee." He said, "That's a freebie." 13th bee is the freebie. All right, that's it. All right, I see comments are working very good. Shauna is showing up with 6 terps today. Thank you, Shauna. And Cody and David are here as well. Fantastic. So yeah, Mavis likes it. Wow, with a bunch of O's, says Mavis. All right, thank you, Mavis. So quick reminder for those of you who haven't already and may be interested, the monthly newsletter I do comes out tomorrow, October 1st. It's the first business day of every month, bright and early, 7 a.m. Eastern time. I know most of you in the group who are already interested signed up, last month, but there were close to 800 people joined the group in the last month, during September. So the post I posted earlier today was really mainly directed toward, the newer folk as opposed to badgering people who are already here about telling them about my newsletter. But anyway, that's coming out tomorrow. If you're interested, you can sign up for that. See the link in my post from earlier today. And weekly disclaimer, this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. Thank you very much. I want to start this by talking about a few background things about charitable giving first. First item is the difference between a gift and a charitable donation. So I actually had a friend of mine ask one time, he was giving away an old car to the son of a friend of his and asked, what the deduction is for it. And I asked him some questions and found out there is no deduction. Just simply giving a car to a friend or a stranger, for that matter, is a gift. And it doesn't need to be a car. It can be anything: cash, your house, a car, baseball cards. I don't know, whatever. Unless you're giving something to a qualified charity, it's just a gift. It's not deductible. I don't want to get off on a tangent about gifts. Gifts generally are not taxable for either the gift giver or the recipient of the gift. But the point is, just giving money or something, property, to family, friend, random stranger, coworker, whatever, is not charitable. It doesn't matter if they need it even. Let's say they have medical expenses they can't pay, and you opt to pay the medical expenses for them. That's still not a charitable donation. It's just you gifting money to someone. So that's number one. You can't donate time or services. So, you can, but you can't deduct it, I should say. So let's say you're a lawyer, for example, and you charge $400 an hour. You can't, or if you donate your time, 2 hours of your time, to a charitable organization and help them with some legal things they need, you can't write off that $800 worth of your time. You can't get a deduction, charitable deduction, for the $800 worth of your time, because your time and your service is not deductible. It's only money or property, basically, or things you can actually take deduction for. As far as how much you can potentially deduct, it depends on, this gets a little complicated. I won't go into it all here. I did a video on it a couple weeks back, I think. Depending whether you donate cash or property, and within property, there's like investment properties, and there's other property, cars, desks, computers, whatever. For the most part, if you're donating, and it also depends what type of charity. So the typical charities you think of are like, Red Cross, March of Dimes, I'm drawing a blank, but all those big name ones that support either a medical cause or humanitarian aid or something. There's those. Um, Not for profit, hospitals and schools, even governments. You can, not that you want to necessarily pay more tax per se, but you can give money to a local or federal government so long as that money you give, you told them they can only use it for something that's for public good. So, like, example I like is you own a house, you pay a property tax, that's not a charitable donation. But if you give $500 to your town and specifically tell them this money can only be used towards the building of this new town park, that's a deductible charitable donation, that $500, but your regular property tax is not. Things like that. And then there's other groups that qualify as charities like war veterans associations and fraternal organizations. Um, those are charities, but they have different limits. You can't deduct as much when giving things to like the war veterans organizations or fraternal societies, as opposed to Red Cross, governments, nonprofits, schools and hospitals, whatever. Those things have higher deduction limits. What are those limits? Most people won't bump up against these, but if you're giving cash, it's generally 60% of your adjusted gross income is the maximum you can take a deduction for. So if you have $100,000 of gross income this year's a bad example, but in normal years, you can get a deduction for up to 60 grand of cash donations you make to these qualified organizations. This year's different. For 2020 only, under the CARES Act, the Coronavirus Stimulus Relief Act, you can get a deduction for up to 100% of your AGI in cash donations. So if you have 100 grand AGI, you can give away $100,000 cash to qualified charities and get a deduction for all of it, thereby wiping out your whole tax bill for the year if you choose to. So that's cash. Property is different. Property is either 30 or 50%. It depends, whether you're giving stocks or bonds, like appreciated investment assets, or you're giving tangible things, desks or cars or other property. That's either 30 or 50%, and it depends. But again, most people don't bump up against that, but just know that it's there. If you want to know more, you can check out the other video I did about it. So what happens hypothetically if you do give a lot, whether it's cash or property, and you exceed the deductibility limit for the year? Not all is lost. Any unused deduction can be carried forward for 5 years. After the 5th year, then it's gone. So if you keep doing massive donations every year for 5 years, such that you can't use up the full deduction, you're going to lose some of that eventually. But most people don't run into that problem. If you're only giving a few $1,000s a year or whatever, and you have tens, if not hundreds of thousands of dollars of gross income, you're not going to run into these deductibility limits. But just know that it's there if for whatever reason you do have a massively large donation year or string of massively large donation years. And one other general comment. So I'm not saying don't give to charity, but don't give to charity if your sole intention is to try to save yourself taxes and money, because you're shooting yourself in the foot. To my knowledge, I don't think there's a way where you personally would ever end up better financially by giving money away to a charity. The example is you give away $1, you're saving, let's just say 30 cents in tax. So great, you save 30 cents in tax, but guess what? You gave $1 away to do it. So net, you're actually down 70 cents from where you were. So don't let giving money away, or don't let trying to save taxes and make yourself better financially be the reason you give to charities, because it's not going to work. You'll be worse off. You give to charities first and foremost because you're genuinely charitably inclined and want to help out whatever organizations or schools or whatever that you're giving to. So that's important to know. It's sort of like when people have mortgage interest and they say, well, I'm going to take out this mortgage because it's giving me a bit of a deduction. Well, yeah, every dollar in interest you pay, you're saving yourself, again, 30 cents in tax. You're still 70 cents worse off. So don't take out a mortgage simply because you think you're better off financially. No. If you do need to take on debt and a mortgage is one of those options, that may make sense because there is the benefit of some of that interest, or that interest could be tax deductible. But don't get a mortgage simply because you think it'll save you taxes, because you're still worse off. Same thing with charities. All right, so now let's get into how to actually give to charity tax efficiently. And this is not more important of a topic, but more relevant now than it was a handful of years ago and prior, due to the increased standard deduction of the Tax Cuts and Jobs Act, which went into place in 2018. the standard deductions were double, and I'll discuss what that means in a moment. But it was like $6,000 a person for a single person. It went to 12. It was about 12 for married folks. That doubled to 24, and they ratchet up a little bit each year. So for 2020, for example, if you're married, your standard deduction is $24,800. Plus, if you're 65 or older or blind or disabled, there's more that gets tacked on top of that. If you're single, it's $12,400 for 2020. Again, there's a little extra if you're 65 or older or blind or disabled. So where you see charitable donations get deductible is on what's called Schedule A of your tax return. That's where you itemize deductions. When you do your tax return, you add up all your income, basically, that's taxable, and you subtract from that your either itemized deductions or standard deductions. So itemized deductions are simply things the government will let you take a deduction for. You add up all of those, and let's just call it X. You compare that versus your standard deduction, which again for 2020 is either $12,400 or $24,800, depending whether you're single or married, plus maybe those add-ons, but let's assume there's no add-ons. So if the sum of your itemized deductions exceeds your standard deduction, you're going to want to take your itemized deductions, which means that's a larger bite off the top of your income that you're taking, so that you'll end up paying less tax. So prior to the Tax Cuts and Jobs Act, a good amount of people itemize. I don't know the exact statistics, but they itemize. So when you're itemizing, charitable donations are itemizable deductions. So if you donated $1,000, then you have $1,000 less of gross income on which you'll have to pay tax because you're able to itemize those deductions. And again, as long as the sum of your itemized deductions exceeds your standard deduction, you're going to want to itemize. And many people did prior to the Tax Cuts and Jobs Act. Now, effective 2018 through currently slated to be through 2025, who knows what's going to happen then, if not sooner, but a lot less people are itemizing and more people are taking the standard deduction because the standard deduction got doubled from what it was. So all else equal, there's more likelihood you're going to use that. And some of the things that you were or are able to itemize either went away or were capped or reduced in how much you can itemize. So the intention was the government wanted to help try to streamline the tax preparation process and said, let's just make it more likely that people will just simply do the standard deduction instead of trying to piece together all these little line items to get to the itemized deductions. And they were somewhat successful in that there are, I think it was, I could be making this up, but like 90% of taxpayers take the standard deduction at this point. And I don't know what it was prior. I'm going to guess it, I don't know, 50-50 maybe. I don't know. I could be off. But point is, like, substantially, almost everyone now takes a standard deduction. All right, let me check some questions here quick. So is there a way to donate to charity from retirement accounts before QCD or age 65? Hold that thought, that question. We'll get back to that. Thank you. Coming up towards the end. Elizabeth asked, how much extra if over 65? Yeah, okay, so Cody responded. Thanks, Cody. Yep. And, okay, so, yeah, Elizabeth also replied to the RMD question. Great, thank you. Right, so that's called a QCD, or Qualified Charitable Donation, donating direct from your IRA, and I'll touch on that. That's one of the points I have for tonight. So let's walk through an example of itemizing deductions. So just a hypothetical here. So getting back, so when it was more likely that you were itemizing, the more you gave to charity, the larger your deduction was, because you're just adding to your list of itemized deductions such that you're taking a larger slice out of your gross income with those larger itemized deductions. Now, when you're doing a standard deduction, you don't get credit. You don't directly get credit for a charitable donation, because it doesn't matter if you have $1 of itemized deductions or $24,000 of itemized deductions. Either way, you're going to get the standard deduction of, if you're married, $24,800. So it doesn't really matter. If you only have $500 of donations, you get no credit for that, because either way, you're getting this $24,800 standard deduction. So a lot of people lost the sort of tax incentive or motivation to give to charity. Again, that shouldn't be your driver, but if it was, or if at least that you were on the fence and that little bit of tax help kind of got you over the fence to donate more money, well, that kind of went away. So let's walk through an example here. one way to help get back or increase the deductibility of donations you make is to bunch them. So I'll start by what not bunching is. So let's say you itemize your deductions, or you attempt to, you do the math to see what it's going to end up to. Typical sort of couple here, your state and local taxes. So that's your property taxes that you pay if you own a house. That if you whatever state income tax you have, that's included here. Prior to the Tax Cuts and Jobs Act, there wasn't a cap on this. And in high-cost states like New Jersey, New York, California, it was pretty easy for people to have tens of thousands of dollars of state and local taxes. Like here in New Jersey, I live in a suburb of New York, typical sort of 3-bed, 2-bath house. It's quite easy to have over $10,000 just in property taxes, if not 15-ish or more. And that's just property taxes. That's not including state income tax you pay, whatever. So it's quite easy to blow past $10,000 in high-cost states. But anyway, that was all capped at $10,000, and this is called the SALT, state and local tax deduction. You may have heard the term SALT. This was one of the more controversial parts of the Tax Cuts and Jobs Act that capped this at $10,000. So anyway, so let's assume you're married. You hit your full $10,000 itemized deduction for state and local taxes. You own a home. Let's just assume you have $7,000 of mortgage interest that's deductible, and you give $5,000 to charity. Sum these up, you have $22,000 of itemized deductions. Sounds good, sounds like a lot, boop. But wait, your standard deduction is $24,800. So you're going to end up taking this on your tax return. All this is basically for naught. Whether this was, again, $1,000 or $22,000, it doesn't matter because you're already getting your $24,800 standard deduction. So even if you donated a couple $1,000s more, it wouldn't have mattered in the sense that you wouldn't have gotten any tax incentive for it. So that's without bunching. This just assumes every year this is the same profile. You got your state and local tax, you're hitting 10 grand. You got your 7,000 mortgage interest, and assume you donate 5 grand every year. Your annual itemized deduction is 22. Guess what? Throw that out. You're not going to use it. You're going to use your higher standard deduction of $24,000 and change. So that's without bunching. So what if you were to bunch together your charitable donations? For example, instead of doing $5,000 donation every year, what if you do $15,000 every 3 years? Let's now look at what that would look like. So this would be one of the years where you do bunch. You still got your $10,000 per year state and local tax. You still own your home, so you're still paying $7,000 in interest. Now, realistically, these figures will change a little bit each year, but let's just assume for now to keep the math pretty. And here's your $15,000 bunched charitable donation. And again, this is every third year you would do this. Add these up, now your total itemized deductions is $32,000. Guess what? That's higher than your standard deduction. Great. It's almost a little more than $7,000 higher. So in this year that you bunch donations, you're now saving yourself $7,200 in tax deduction that you otherwise wouldn't have got if you did these charitable donations to the tune of $5,000 every year. So this right here saves you. Every third year, you're saving yourself a pretty good amount of tax by clustering and bunching together your charitable donations. That's bunching. That's strategy one, if you will, how to get the most tax efficiency out of your charitable donations. All right, some quick questions before going on to 2. Dave, man, stealing my thunder. In 2020, the IRS will allow a $300 extra charitable deduction over the standard deduction because of CARES Act. Thanks, Dave. Yeah, that's my last point for tonight, but I will come back to that. Great point, Dave. Elizabeth throwing in some more stuff here as well. Okay. Right. And Terrence is asking Dave, is that $300? Yeah, hold that thought, Terrence. I will comment on that at the end as well. All right, so that's strategy one, if you will, bunching charitable donations. Great, it works, fine. Your concern may be, well, my charity is lean and runs efficiently, and every dollar they get really matters. So they can't go 2 years in between with getting nothing from me. They really need that $5,000 every year. Not to worry, there's another alternative called a donor advised fund, or DAF. You'll commonly see it as an acronym. That is where you open up a fund at a major, most custodians or brokers, Vanguard, Fidelity, whoever, will offer donor advised funds. You open it up, sort of just like you open a regular account there. There's more to it than that, but on the surface, it's kind of like you open an account. There's a paperwork process, what have you. and they open up a donor advised fund. You put money into that fund, and when you put that money in, it's considered a charitable deduction or a charitable donation that's deductible. Once it's in the fund, you can't get it out. I don't know if I honestly didn't look into this. Maybe there's some like extreme scenarios where you can get it back out with penalty, whatever. But assume once you have it in there, you can't get it out. That's its own entity. You basically gifted that money irrevocably once you put that money into that donor advised fund. So you get the charitable donation at the time you put it in. Now, the beauty of it is the money can stay there. You control how it gets invested, when it comes out, and where it goes. Again, you can't take it out for yourself. Once it's in the fund, it can only go out to qualified charitable organizations. So you can let it sit in there for a few years, and you can control what it's invested in, so it can grow while it's in there. So you therefore have more money to give out to the charities when you eventually choose to distribute to the charities. You can have it parked in cash if you want, whatever. But there's flexibility. So you can still do the bunching concept where every 3 years you're putting 15 grand into your donor advised fund. So every third year you're going to get that larger itemized deduction and therefore the tax benefit for it. But once the money's in the fund, you can then dole out 5 grand a year to your favorite charities. So the charities still get their 5,000 every year. You still get the benefit of bunching your contributions every however many years. So you get the tax benefit for it. Everybody wins. If you want to see that in a chart, I didn't make this. It's not that complicated of a thing to grasp, but I had this slide made up for something else anyway. So basically, here's how it works. You open up a fund. Think of it just like an investment account, essentially. I mean, it's different, but conceptually not that far off. You put money in whenever, and that's a charitable donation when it goes in, which means it's tax deductible. If you can itemize it, then you get benefit for it. The money sits in the fund. Could be a few weeks, could be a few years. You invest it, you do whatever. You choose when it comes out and where it goes to. You can have all the money come out and go to one charity. You can split it out and go to multiple. There's no deduction on the back end because you already took your deduction when you put the money in. That's it. That's where your tax benefit stops, upon entry to this DAF or donor advised fund. Once it comes out, there's no benefit to you at that point. That's just money going straight to the charities. So that's donor advised fund. That's number 2. Cool. All right, questions? All right, so third item, QCD or qualified charitable distribution. This is when you have an IRA, a traditional tax-deferred IRA. If you are 70 and a half or older, you can make a charitable donation direct from your account to a qualified charitable organization. Why would you do that? A few reasons. Well, let me first talk about the other way people may think to contribute money from an IRA. So you have an IRA. Let's say you want to give $500 or $1,000 to charity. You may take $1,000 out of your IRA as a normal distribution. You have to pay tax on that $1,000 distribution. You then turn around, you take your $1,000, you donate it to whoever. You now hopefully you get a deduction for $1,000. Again, if you're taking the standard deduction, not itemized, you kind of lose the ability to deduct it. But if you're itemizing, then yes, you would get a $1,000 deduction for that charitable donation. So it may seem like, great, it's a wash, everything's cool. Not necessarily, because you still increase your AGI. The tax you pay will be offset because you get the deduction, but your AGI was still jacked up by that $1,000. And it's AGI that counts for other tax things, like your Medicare premiums, like your ACA subsidies, like how much of your Social Security is taxable. Like if you have enough income that this matters, the net investment income tax, which is an additional 3.8% tax that gets slapped on your passive income, like dividends, interest, capital gains, rental income. AGI matters for that. So you can avoid all this nonsense. If you're going to give money to charity and the money's ultimately coming out of your IRA and you're over 70 and a half, do a QCD. The money goes straight from the IRA custodian, Fidelity, Vanguard, Schwab, whoever, straight from them right to the charity. Do not take the money out to yourself to then turn around and write a check to the charity. The big thing, it has to go direct from the account at the custodian straight to the charity. You don't get your greasy hands on it at all. That's what happens for a QCD. When you do that, the money you take out by way of the QCD doesn't hit your adjusted gross income. It just gets skimmed right off your IRA, basically doesn't show up on your tax return. And so the charity still gets it tax-free. You don't have to pay any tax on it. It doesn't inflate your AGI at all. And it's that much less taxable income you'll eventually have to take down the road because you're skimming off $1,000 or however much straight from your IRA. The other beauty of it is when you turn 72, you need to start taking distributions out of your tax deferred accounts. Whether you need the money or not, government don't care. You have to start taking it. It's called the RMD, required minimum distribution. And when you take it, you need to pay tax on it. That's why they make you take it, because they don't want you deferring taxes forever, kicking the tax can down the road forever. They force you to take money out and pay tax on it starting the year you're 72. There aren't any ways to avoid RMDs other than a QCD. So when you're 72 and you have to take out an RMD, you have to take it. You can buy certain annuities with it called the QLAC, not to get off track, but that doesn't get rid of the RMD. That just kicks it down the road as well. So anyway, you have to take the money. QCD is the one exception. If you have a $10,000 required minimum distribution, for example, you can QCD that all away. You can do $10,000 qualified charitable distribution straight from your IRA to charity. That will meet your requirement to take out the $10,000. Good. Again, only do this if you're charitably inclined. Otherwise, you're giving away money just to save yourself some tax. But if you do give to charity anyway, and you have an IRA, and you're over 70 and a half, I'm going to go so far as to say all of your cash contributions, at least, should come straight from your IRA by way of a QCD. Don't just write checks from your checkbook. Don't take IRA distributions, then write checks from your checkbook. Straight from IRA to the charity by way of QCD. Again, traditional IRA, you have to be 70 and a half. Those are the conditions. And straight to the charity. Don't let it touch your greasy hands. Make sense? So, and per person, you can only, I say only, but you can only QCD up to $100,000 per year. And if you're married, that's per person. So married couple, in theory, can each give away $100,000 straight from their IRAs to charity by way of a QCD every year. Okay, let me get some questions here. So Chris Sloan, can a QCD come from a 401k as well or only an IRA? Good question. I'm fairly certain it's only an IRA, Chris. 90% certain on that. Not 100%, but I'm pretty sure. Mark asks, how do capital gains work in a donor advised fund? Can you put appreciated stock in there to avoid capital gains tax? Yes, good question, Mark. So I should step back. So with a donor advised fund, think of it like an IRA or Roth IRA. Once the stuff is in there, it doesn't matter what happens in there. There's no tax impact to you as that stuff is happening. Whether it goes up or goes down in value, doesn't matter for you. Especially in this case, because it's not your money anymore. Once you donate it in, it's gone. It's not yours. But yes, so Mark's question is, can you donate appreciated property, i.e. stocks or bonds, to a donor advised fund? Yes, I believe so. I don't know this with certainty, but I'm fairly sure you can, Mark. And the amount of, or the dollar deduction you can get for those donated appreciated securities are going to be subject to different limits. And that was in my video. It's either going to be 30% or 50% or maybe even 20, depending on the organization, of the value of the security that you put into it. But yes, barring all these little what ifs and caveats, you can take appreciated securities held in a regular brokerage account, donate them into a donor advised fund, and you can fund it that way. And you get that unrealized taxable gain off your hands because you're now giving it to the charity effectively. The donor advised fund is a charity. Good question, Mark. Steph Suter, can you write multiple QCDs a year subject to other limits? Yes, you can. Now, maybe the custodian will put a limit on it. The IRS doesn't. But if you're calling up TD Ameritrade once a day to do a QCD, they're probably gonna be like, cut it out, jerky, because it's processed for them. But yes, barring the custodian preventing you from getting carried away with making too many QCDs and bothering them in their operational process, there's no limit to the number you can do. There's a limit to the amount. Again, that's $100,000 per year in QCDs, but there's not the number. Chris asked, can a QCD be used prior to age 70 and a half? No, you need to be 70 and a half or older, Chris. Elizabeth, can you do a QCD to yourself, to self-directed charitable trust? One other thing. So QCD cannot be used to fund a donor advised fund. That's an important point I forgot to mention. Um, Donor advised funds are great. QCDs are great. You can't put these two great things together. That's one of the hard written rules that the IRS says about QCDs. You cannot use it to fund a donor advised fund. I'm not entirely sure why, but such is life. So anyway, so Elizabeth's question, can you do a QCD to a self-directed charitable trust? I don't know. That's a good question, Elizabeth. And frankly, I'm not an expert on charitable trusts. I know of them. I was going to just throw a brief comment in the end about some of the options that are out there, but I don't know, Elizabeth. That's a good question. My guess, I'm going to say my guess would be no, but I'd have to look that up. I know you can't use it to fund a donor advised fund. I also think you can't use it to fund a private foundation. So if you create a family foundation, you can't. But if it's a self-directed trust, that I don't know. You might be able to, but I'm just guessing. Okay, so Cody's saying QCDs can only come from IRAs. Great, thank you, Cody. At age 72, do you have to do RMD first in a QCD? No, David. So David's question, at 72, do you have to first take out RMDs and QCD? No. So interesting question, David. Generally, when you do, in the year you're 72, you need to start taking these RMDs or required minimum distributions from your traditional tax-deferred IRAs. Other than a QCD, RMDs need to be the first dollar out every year. So you can't take like, what's the example? So if you want to do a rollover, for example, right? You have a $100,000 IRA, you're 73 years old, so you're definitely in RMD age, and you want to roll 20,000 of that to another IRA. You can't roll it and get yourself an account of 80 and then say, okay, my balance is now only 80. The first, any dollars that come out of that IRA during the year need to first be considered your RMDs. So your RMDs need to be taken before you do any rollover or something, if that makes sense, David. The exception is QCDs. Again, the example is, let's assume you have a $10,000 QCD you need to take for the year because you're 73. You can erase all 10,000 of that QCD, of that RMD, by doing a $10,000 QCD. Or if you do less QCD, so for example, you only do $2,000 qualified charitable distribution, and you had a $10,000 RMD, you'll still need to take the $8,000 difference as an RMD. Make sense, David? Kelly asked, how often can you do a traditional IRA to Roth? Kelly, I assume that, okay, so yeah, Roth conversion, as much as you want. Again, the custodian may set limits just to prevent you from doing like excessive amounts of transaction and paperwork, but the IRS doesn't limit you to the amount you can convert, the number of times you can convert, the age you have to be at which you convert. There is no age min or max to do a conversion, so you can do it however you want, how much you want, whenever you want, subject to, again, the custodian may put limits on you just to prevent you from doing like 5 different conversions every day for a month. You would be their least favorite client. They'd probably kick you out at that point. Kelly, that's my guess. Okay, so that was QCDs. Good. Next is to donate appreciated securities, like stocks or bonds. Now, these would be things you hold in a regular brokerage account, not a tax sheltered or tax-free world wrapper like a traditional IRA or traditional Roth, because whatever you buy or sell on those things have no tax consequence while you're doing it. It's only when you take stuff out that there may be a tax consequence. Whereas if you have a regular brokerage account that you fund with after-tax money, there can and likely will be tax implications along the way every year as bonds throw off interest. That's taxable in the year you get it. As stocks generate dividends, those are taxable in the year you receive it. And then if and when you sell something, that could possibly, you're going to either have a tax owed on the gain or it'll be a tax shield if you had a loss on it. But nonetheless, selling something inside a regular brokerage account triggers a taxable event. So if you have, 2 decades ago, you bought some Microsoft for $10,000 and now it's, I'm just making this up, I don't know what its growth was, but now it's $100,000. you have $990,000 of taxable gain that you're going to have to realize whenever you eventually sell these Microsoft shares. Good problem to have. I mean, paying tax means you have money or made money, but if you can avoid it, why not? So if you're going, again, if you're charitably inclined anyway, don't do this just to try to save yourself tax because you're still end up with less money. But if you're charitably inclined anyway, it may make sense to give away these highly appreciated securities because you have this $990,000 taxable gain just lurking over you. Whenever you sell it, you're gonna have to pay some tax on it. You can give that away, and that gain gets given away with it. So it's no longer your taxable problem to worry about. And because it's a charity receiving it, charities don't pay tax. So just like they don't pay tax when you give them tax deferred money from an IRA, they don't pay tax when you give them appreciated securities that would otherwise be taxable in your hands if you sold it. The recipient charity doesn't have to pay tax on it. So giving appreciated securities is another way. There's some deductibility rules. Now here is more likely where you may bump into these maximum deductibility rules. So for giving away appreciated securities, this gets pretty complicated, but don't dwell on this too much. It'll make your eyes spin. If you're giving away appreciated securities, it's going to be one of these two things. You're limited to either 30 or 50% of AGI as a deduction. It depends if you held the property more than a year, and it depends if you're trying to deduct its current value or you're trying to deduct the cost at which you bought it. Anyway, so you may be capped out at only 30% of AGI. So if you're trying to give away this, almost, what I say, $1 million or $100,000 of Microsoft, whatever number I said, it's possible that may hit the 30 or 50% of your AGI, and you may get sort of stopped out from being able to deduct it. Again, not the end of the world, because that excess deduction you couldn't take will carry over for 5 years. But nonetheless, giving away these securities could be a good way to get some lurking potential tax bill off your hand just by donating. Again, if you were to donate anyway, this could be a good option for something to give away. All right, one more point, and let's see, Dave says, I have a plan to use QCDs to try to get my yearly income under tax bracket levels and IRMA triggers. Bad idea, question mark. It won't help you in the years you're doing it, Dave. So like if you need money to live, and you're taking $1,000 out of your IRA by way of a QCD, well, that doesn't help you because you're not getting any money out of it, right? So that doesn't get you there. But if what you're saying is, I don't need this IRA money anyway, let me give it away so that when I do want or need to take it, the amounts I'm going to have to take will also be lower because I will have given away some of it. Yes, that in theory could work, Dave. If you give away enough that it actually moves the needle. Such that when RMDs hit, the RMD is going to be lower and below whatever threshold you're trying to keep yourself under. So, no, not a bad idea. I think it's not as simple. It's hard to really get a precise figure because there's a lot of variables. Like you don't know what the returns are going to be in your IRA. Hopefully they're good, phenomenally good. That means it's going to keep growing. So you'd have to give away more and more to try to keep your RMD amounts down. So you really have to weigh, again, don't give away money just to try to save taxes because I'm almost certain you can never end up better off financially that way. Spiritually, yes, different story, but just pure dollars and cents. It could work in theory, but it would take a lot of like what if and modeling and who knows what the future is going to hold, Dave. So not a bad idea, but I can't say with certainty that yes, it will definitely make you better off and avoid other taxes down the future. And then Lori said, is your QCD only allowed to be your RMD, or are you planning to do more than your RMD every year? I'm still trying to understand the limits of QCD. So Lori's comment was replying to Dave, but no, Lori, the QCD can be up to $100,000 per person per year. So if you're married, that's you and your spouse could each QCD up to $200,000 per year. So that can and will surpass your RMD presumably if you're actually giving away that much through QCD. So typical example, let's say you have $1 million IRA and the first year of RMDs is 72, where the percentage you need to take out is 3.9%. So your first year's RMD on your $1 million IRA is going to be 39,000 bucks, let's call it, Lori. You can QCD nothing, and you'll have to take all $39,000 as a regular taxable distribution from your IRA. You can QCD 39,000 on the dot and completely wipe out your RMD. I'm confusing my letters here. In that case, you have no taxable income and no additional monies you need to take out of your IRA because your QCD is completely offsetting and accounting for the RMD you'd otherwise have to take. Or if you're truly charitably inclined, you can QCD up to $100,000. Again, your RMD is only $39,000. That doesn't mean you can't give away $100,000. So then you're more than covering your RMD plus a whole bunch more with no tax implications to you. Or no taxable income to you. The tax implication is you'll have less taxable income down the road because you're just shoveling off money from your IRA that you're not going to have to take out and realize later. Hopefully that answered your question, Lori. And Cody Garrett CFP saying, reminder not to donate securities at a loss. It's more tax advantage to realize a loss than gift the cash proceeds. Yes, great point, Cody. So giving away appreciated securities could make sense from a tax perspective because you're getting that unrealized taxable gain off your plate. If you have something at a loss, you bought it at $100, it's now only 80. You can give it away if you want, but it wouldn't be optimal to do that because you have that $20 unrealized loss. So that if and when you do sell it, that's going to reduce your taxable income by $20, the amount of that loss. So that would not be wise to give that away. There's other more tax efficient things to give away. Securities that have a gain are much better to give away, or just straight cash in that point, because you don't want to give away that $20 deduction you're going to have when you sell that security at a loss. Cool, good point, Cody. All right, and the final one is the special CARES Act 2020 exception so normally you can only get deductions for your charitable donations if you itemize and don't take the standard deduction. And that implies the sum of your itemized deductions is larger than your standard deduction. But what if you take your standard deduction simply because your itemized deductions aren't large enough? Fine. For 2020 only, under the CARES Act, you're allowed to deduct, it's not a deduction, it's a reduction from income technically, but you could think about it as a deduction effectively. If you take the standard deduction, this doesn't count for itemized. Only if you take the standard deduction this year, you can deduct up to $300 of charitable donation on top of your standard deduction. So again, married folks, let's start with single. $12,400 standard deduction this year. If you give away $500 to charity, you can additionally deduct another $300, up to $300 of that on top of your $12,400 standard deduction. Now this was someone's question. What if you're married? Can each spouse get a $300 deduction? The IRS has, to my knowledge, has not issued definitive guidance, but myself and others in the industry are of the opinion, based on how the CARES Act is worded, is that you do not double this deduction if you're married. It's $300 per return, essentially. So whether you're single or you're married, $300 is the most you can get on your return. So if you're married, for example, your standard deduction would be $24,800 or more if you're 65 or older or blind or disabled, but let's assume you're not. So you're going to get a $24,800 standard deduction, and you can deduct an additional up to $300 on top of that for charitable contributions in the year. Again, that's only 2020. And it's possible maybe it'll be 600, maybe it'll be double for married folks. Act on the assumption it's not until the IRS says otherwise. And we'll know in January when the final 2020 version of the Form 1040 comes out. Then it'll all be decided and you'll see it clear as day what you can and can't deduct. For now, assume it's only $300. And again, you can only do that if you take the standard, not the itemized deduction, and that's only for 2020. Done. That's all I have today. If there's any other questions or comments, feel free to plop them in. Next week's topic will be pretty high level. So, as a lot of you probably noticed, some of the stuff gets really technical, and a lot of the content that I go over fairly involved. So, for the well-versed DIYer, DIYers out there. I think you guys like this content, whatever, but I think this is a little too technical in advance for people who are just sort of starting out in their retirement planning educational journey. So what I'm doing next week is I'm going to do a summary of the 4 different account types, kind of a one-on-one level class. I'll be discussing regular brokerage accounts, Roth accounts, tax-deferred accounts, and then I'm calling HSAs the 4th type of account. So that'll be pretty high level. Talk about the ins and outs of those things and what to look out for. So if you're interested, come back for that. Otherwise, check out the schedule for following weeks. There'll be some more sort of technical advanced stuff later on, obviously. And as you probably noticed, I'm going to start folding in special guests. My goal is to do it once a month, partly to get in other experts who have more expertise than me in certain things, and to give you all a break from looking at my mug sitting up here yapping away every week. So next month will be the first one. That'll be Danielle K. Roberts from Boomer Benefits. She's, in my opinion, in my mind, one of the preeminent experts in Medicare in the country. So she'll be on. We'll be talking about Medicare, taking some questions. A month after that will be Brian Williams, our own group's Brian Williams. He's an expert in the retirement plan space. He'll be talking all about looking into 401ks, how to dig into it and find out how good or bad are your funds, what are the fees, not just the funds, but the other fees in the plan, fiduciary-ness of the plan and why that matters, stuff like that. December, still looking to iron that out, but potentially Devin Carroll, who's one of the country's Social Security experts. He's got a massive YouTube channel, books, the whole kit and boodle. So we'll be on talking about Social Security. And then I have a handful of people tentatively lined up for 2021. Don't yet have the dates nailed down, but hopefully you all will like this and learn a lot from it. And it'll be good to ask questions of people who are truly experts in their specific fields and knowledge areas. So anyway, Wendy, last question. Were donor advised funds already discussed? If so, I'll watch the first part of the video. Yes, donor advised funds were discussed, Wendy. Also, I did a YouTube video, one of my boring scripted educational YouTube videos that covered donor advised funds. I did it a couple weeks ago. It was called something along the lines of Understanding Deductions for Charitable Donations or something. Check that out. There's more info about donor advised funds, Wendy. And Debbie, 401k Roth too, I've heard treated different than a Roth IRA. Yes, I'll be mentioning that next week, Debbie, when I go over my summary of the 4 different account types. Again, Roth, tax deferred like a regular IRA, normal brokerage, and then HSA or health savings account. All right, that's it. Thank you all for joining. I will see you next week. Take care.